I'm going to introduce first Jean-Marie Eveillard. He is a legendary portfolio manager at First Eagle. His views on investments were often conservative, but his results were not. He was at the top of the heap for international funds over an extended period of time. And he, something that we haven't discussed much, but he's also an intense gold investor. If you want to, any question to him about that, you might raise that question. We'll be sending around questions, and if time permits, we'll direct those questions at each of our people. Now, Jean-Marie is on the board of trustees for First Eagle Funds, and it's going to be interesting, personally interesting, after knowing him for so many years, to hear his views. It's appropriate that he be introduced first, because this is the third time he's been with us. Each time during an anniversary, 20, 25, and now 35. So what I'm going to do is introduce Michael Shaoul. Michael is portfolio manager at Marketfield Fund. And I met him at a charitable event and quickly saw his capabilities. I asked him if he had a vehicle we could invest in. He said not yet, but he came around to talk to us. He and his partner, Michael Arenstein, predicted the 2008 crash. Now I'm going to say that again. That is really magical, and he did it before, in front of us and in writing. So this was not made up. And he took advantage of it for his new investment vehicle. His fund on balance has been the leader in his segment of the market, including being the #1 fund for alternative investments for the recent 12-month period. This is the second time that he's appeared, and his partner, Michael Arenstein, has been with us once. The third person is Amit Wadhwaney, past manager of Third Avenue International Fund, and now portfolio manager for Moerus, his own firm. He learned under another legend, Martin Whitman, who recently passed away. He is a keen, deep, independent thinker with a way of digging and finding undiscovered values in securities. He's able to keep his risk down while dealing with investments abroad, making his alpha. You all know a little bit about it. We talked about it, but you're going to know even more about that. Alpha being risk-adjusted returns over time have been very attractive. He is a first-time speaker for Altfest. I'm going to start by asking each panelist a question, much like, do you know who he is? Fareed Zakaria on CNN. I love the way he does that. So I'll have a feeble duplication on his Sunday CNN show. So let's start with Michael Shaoul. Recent volatility, although not high, has picked up, indicating greater uncertainty in the markets. What is the economic and investment outlook that you see?
The first thing I'm going to say is that we're dealing with, I would say, fairly normal levels of volatility. And what was really abnormal was that period from mid to late 2016 and really the whole of last year, where almost nothing happened, or one good thing happened, which is asset prices went up a lot globally. But you didn't really have the sort of bouncing around that we have right now. And since late January, it's been a more difficult investment environment. But this is part and parcel of a normal bull market. If you went back and look at what looks like a really good year, 1997, where the S&P was up more than 30% by the time the year was ended, to get from A to B and make your 30%, you had to absorb a really difficult period between August and late October. In fact, the only time the stock exchange is closed in the middle of the day since the '87 crash, when we put theoretical trading limits in place, was October '97. So as I say, this is a fairly normal environment. I think what is volatile right now in terms of actual activity is geopolitics, or maybe we should just call it politics, period. You are seeing a rise of populism, both within traditional parties, such as the Trump administration, which is it's a Republican administration, but it looks nothing like any other post-war Republican administration. I don't see this positively or negatively. I leave it to the audience to make their decision. But it is something quite different. And what we see in a number of European countries and a number of emerging markets, which is less traditional political parties coming to the fore, either actually being elected to lead a coalition, such as in Italy, or potentially being elected in countries such as Brazil. What I'll say right now is that it's fairly clear that the market has made its peace for the time being with Trump-style populism. The market has decided that the changes to the tax code and the tax cuts at the end of last year and the promise of more corporate activity coming from that, the market has taken a benign view of that and likes it. And what the market doesn't like right now is the promise of populism in Italy or the promise of populism in Brazil. Markets are not always right, but at this current point in time, any whiff of populism in international markets is being treated as a need to sell. My guess is that's exaggerated. It's not clear whether or not what happens in Italy is going to be good for their economy over the next 18 to 24 months. I think that is certainly the case in Brazil. Our current feeling is that a lot of the volatility, which is taking place mostly in foreign exchange markets and less in underlying asset markets, is really very opportunistic trading. You've seen some great results for some of the large macro funds in May, and that tells you, I think, that they've been the guys really pushing FX around, but I don't view that as a reason to be worried. Where we don't see volatility, and this is a good thing, is in economic data. Global economic data continues to be of a very high quality. You have seen some commentary suggesting that outside of the US that's no longer the case. I would push back on that fairly hard. Trade data, import and export data, which tends to be reliable, still looks pretty good. And the global economic expansion that accelerated in 2017 still looks intact in 2018. And as far as corporate earnings are concerned, this corrective period, this difficult period, which has been going on for 4 or 5 months now, covers actually 2 earnings seasons, which are the 2 best earnings seasons we've seen over the course of this, cycle. So, I still see a lot that I like in the investment environment, but we're not going to go back to that very specific 2017 experience. To continue to make money, you're going to have to stay invested, and to stay invested, you're going to have to absorb more volatility, and that just is what it is.
Okay, very good. That's almost like a Bloomberg TV extended out a little bit. But he's on all the time, and I look at it all the time. Jean-Marie, the next question is yours. By the way, Jean-Marie gave me this book and the book is called Value Investing Makes Sense. And my question is going to be on that. So we're going to give you a little taste of Jean-Marie, putting what it would be in baseball, a pitch right down the center of the plate. Value has underperformed over the last decade. It's a good thing Altfest has been flexible in defining the term value loosely, which has enabled us to provide attractive returns. Is it time to throw in the towel and select growth stocks such as technology?
Well, you know, Warren Buffett said value and growth are joined at the hip. There is deep value, which is, reliance on Benjamin Graham's book, The Intelligent Investor, which incidentally Warren Buffett continues to say is the best book ever written about investing. And then there is the adjustments which Mr. Buffett has made to the teachings of Ben Graham, considerable adjustments, illustrated by the fact that he's looking for moats, as he says. In other words, businesses that have a sustainable competitive advantage. And so, yeah, I mean, value, there is a side to it which is reliance on Ben Graham, and there is a side to it which relies more on Buffett. And at the beginning, when I came back from France and took over what was at the time a $15 million fund, and incidentally, I'm here today to some extent because I owe Lou. Lou, so the firm was created in 1983. In the mid to late 80s, before we reached the level of $100 million, when we were still which in America is a small fund, Lou sort of was interested in what we were doing. And at a time when we were small, and it was important that people like him would show an interest in what we were doing. But what was I talking about before?
You're talking about value.
Before I made my pitch.
Mm-hmm.
So there is the Graham approach and there is the Buffett approach. And again, Buffett, nevertheless, even though he's made considerable adjustments, and when we were small, but I got lucky. I mean, luck is important. There is a story about Napoleon where he was surrounded by a few aides and they were talking. And one of the aides said, "Oh, General so-and-so, he's lazy, he's chasing women, he's corrupt." And Napoleon interrupted and said, "Yes, but at the last battle, he was very good." And the aide said, "He was lucky." And Napoleon jumped up. He said, "I want lucky generals around me." Napoleon understood that in the midst, on the battlefield, things get messy. And it's important to have lucky generals. And luck, I mean, there is no doubt. Luck, as we all know, plays a role in life. And my luck was that in the early to mid 80s, because the 70s had been a difficult period for equities in general, as a result of inflationary times, particularly in continental Europe, there were a number of stocks, particularly small stocks, but since our fund was small, we had no problem with small stocks, that were selling at ridiculously low valuations. They had been abandoned. In the 70s, investors had progressively abandoned those stocks. And there were and there are very few value investors in France. And I was saying to myself, well, maybe I'm missing something. So I called a money manager I knew in France, and I said, "What am I missing?" He said, "What you're missing," he said, "is the fact that if we locals don't buy those small French stocks, they will never go up." Which was idiotic, of course. What he meant or should have meant is that the value investor should be there was a quid pro quo. In other words, yes, maybe at some point the stocks would go up 4, 5, 6 times, but maybe you will have to wait 5 or 7 years before that happens. So you will have to be even more patient than value investors have to be patient.
That's good. In general, we didn't have so much patience. We didn't have to have so much patience for your.
Lou, in my next life, I will run a closed-end fund.
That means one that you can't get out of.
That's right.
Okay, Amit. By many measures, the stock market is on the high side. As a global fund manager, do you agree? And has that made it difficult to find attractive investments for your portfolio?
So if you look around you, you'll see lots of markets around the world having gone up for a number of years. I mean, part of it, of course, was the post-global financial crisis environment where, of course, things were goose, things went up. And it's particularly true in a number of countries, the United States, for example. But one thing which is very important to remember, a market is an aggregation. I mean, first of all, when one thinks in terms of market indices, there's a certain amount of seduction bias of what goes on in various indices, for example. So just if I can just illustrate by way of example that an index is not necessarily representative of what lies below the surface. For example, a country like Chile. Chile is a country which has always had an extremely expensive stock market as measured by the index. The reason behind that is very simple. The Chileans built this incredible pension fund system which had to keep buying the stocks, and the stocks always stayed expensive. However, below that, there was another layer of second-tier companies, smaller companies, which over the years, you'd find lots of opportunities to buy things that were quite inexpensive. So I suppose where I'm going with this is many stock indices, including clearly in this country, are expensive. There's no question about that. But if you look past the indices and look at individual securities, opportunities exist. And we tend to be fairly disciplined, fairly stingy investors. But just as a note, the last 3 securities, and we don't buy many securities, we don't turn them over very often. The last 3 securities that we bought, 2 of the 3 we bought were in the United States. They just happen to be absurdly inexpensively cheap. So now, abstracting from this, you have, I mean, again, what we traffic in is not just US-based securities. We look around the world, developed countries, developing countries, emerging frontier, and so forth. So there are things to do. But what I will say, what is true, is there are somewhat fewer things to do than, let's say, 2, 3, 4, 5 years ago. Clearly, this sort of reflation and reflating and pushing away has certainly elevated prices, but yet there are things to do. I mean, I'll just give you 2 quick, very generic sort of examples. One, look for excesses, things which have there have been excesses which have cheapened things. One very visible excess, I'm not saying it's turning around, so this is not an economic forecast, that I will leave to other people to do. One of the great excesses is unusually low interest rates in continental Europe. Again, I repeat, this is not to say it's turning around and rates are going to shoot up. I'm not saying that. Merely, all I'm saying is low and really low interest rates hurt a whole collection of businesses and industries. One in particular is life insurance. Life insurance companies do make money investing in portfolios in fixed income securities. The lower the interest rates, the less they make. And negative interest rates are particularly toxic for them. So that's one class of opportunities low interest rates have provided us. Another class of opportunities, which is quite intriguing, is actually a fairly broad class, is businesses which operate in countries that have been oil impacted. Now, you can obviously buy oil securities. There's a very direct one-on-one relationship quite often with oil prices. Oil prices do well, these companies do well, and you do well. But countries which were, over the years became unusually dependent on oil. Remember, oil was $140-something a barrel. And then, of course, it crashed to 25. Many of these countries were stranded in some very peculiar, unpleasant situations. Not only were the countries in unpleasant situations, but people lived in those countries because the economic activity contracted. And, of course, as a result of that, this resulted in very interesting opportunities. Buying retailers, for example, in such countries has been an interesting source of opportunity. So there are things to do. There's somewhat fewer of these things to do, but actually some of these things we're seeing are actually decent quality things in terms of investments.
Okay, very good. Amit's fund provides us with a sleeve in North and South America that we don't have much of a representation elsewhere, and we like people who find attractive securities in different areas. Let me go back to Michael and ask a question that's on a lot of our clients' minds. Will we have a trade war, and what would its impact be?
I don't know. It's something which has emerged as an issue, really from sort of February, March onwards. My best guess is that we're going to have a trade argument rather than a trade war. We're going to have a lot of trade rhetoric. I think the situation that we have today is a post-world order or a post-China entering the modern world order, which I think the US has a pretty good case to say that it's been adversely impacted by. What I've written is that the US seems insistent on taking a fairly reasonable argument and positing it in the most unreasonable way possible. And the Chinese, who one could argue have, from an economic perspective, run a mercantilist regime. That means a regime which has deliberately protected its own industry and commerce at the expense of nations that it trades with, and yet have used the most reasonable language possible. And that's the sort of situation that we have right now. My current assumption, and I would be invested differently if I didn't believe this, is that we will, for the time being, avert a true trade war, that we will have a lot of rhetoric, we'll have very messy deals. The best example we have right now is a Chinese company called ZTE, which outside of a trade dispute was sanctioned for illegally working with Iran a few years ago, promised to stop doing so, and then was caught with its pants down doing it again, and was effectively threatened with being put out of business by US sanctions. That sort of took place to the side of the trade war with China. The Chinese responded to that by simply not buying American soybeans very quietly, or quite noisily, didn't buy American soybeans. The net result we have today is ZTE signed, I think, I read a headline, I didn't read the story, but I believe that ZTE did sign off on an agreement with the US. In Russia, where, again, we've imposed sanctions, there's a sort of blurred line between sanctions and a trade war, something which we would call a reasonable sanction, the receiving end would call the beginning of a trade war. Russia, again, where we effectively put Rusal, which is one of the world's largest aluminum companies, out of business on Orthodox Easter, Good Friday for Russians, not Good Friday for Americans. Looks like Rusal is not going to be put out of business. It looks like the oligarch in control of Rusal is going to be allowed to take his stake down from the mid-50s to the mid-40s, and everybody's going to say that we're back to the same spot. So at the moment, as I say, it looks like we're going to have a lot of trade arguments. It looks as if this is something that markets are going to have to deal with. There certainly is the possibility that you have what I would call a genuine trade dispute at some point in the future. But I don't think we've reached that point. I don't think we've reached that point today. The only thing I'd add is the market is a little bit schizophrenic about it. At the moment, trade is very much being treated as a global issue, in other words, a non-US issue. The US equity market is less and less affected by adverse trade rhetoric. Emerging markets, Asian markets in general, I would say, actually, because it's not, Japan has been pulled into this to some extent, have been very much for sort of whipping boys, and again, I'm not sure the market's really being efficient about this, but for sure, I think the global order, which we somewhat took for granted over the last 20 years, is changing. And my belief is it will continue to change over the next 5 to 10 years and will be quite unrecognizable at the end of that period.
Okay. Next one to Jean-Marie. What is the outlook for the European, what is the fundamental outlook for the European Union and Europe?
Well, the problem which many people identified, but nobody listened to them, at the time of the euro is that you cannot have, or at least we did have, but in the end it becomes difficult. You cannot have a currency that applies to several countries, and those several countries, the French continue to decide themselves what their taxes will be. The French continue to decide themselves, and the Dutch and the Germans and the Spaniards and the Portuguese as well. Each country continues to decide, make the major decisions about their economy. They want to raise taxes, they want to reduce taxes, they want to do more government spending, less government spending. It's to each his own. And it simply cannot work over time. It simply cannot work. At some point, you have what I would call Northern Europe, the Germans, of course, the Dutch, and a few others up north. And you have the southern countries, including France, unfortunately, although maybe things are changing now. But Italy, Spain, Portugal, Greece, of course, and so the French are trying to convince the Germans that maybe we should progressively move towards a European government or something somewhat similar. But the Germans are reluctant because they're afraid that it would be at the expense of Germany. So the situation continues to be unstable. At the same time, just as the central bankers after the financial crisis, or at the time of the financial crisis, decided to take absolutely unprecedented steps in terms of the quantitative easing and etc., which certainly helped the. Let me put it another way. The central bankers, not just the Federal Reserve, but the European Central Bank and the Bank of Japan, they created a bubble in the bond markets, a bubble in the stock markets, a bubble in the high-end real estate market, a bubble in works of art, particularly contemporary art. Who owns those four types of assets? Very rich people. Now, at the other end, you have the lower middle class does not really save, or not much, but the middle class does save. And what do they get? And usually, if they know about Lou, they will be involved with equities, with bonds, etc. But many sort of focused on bank deposits. What kind of interest rate do you get today on a bank deposit? Almost zip. So you have very rich people who have become even richer than before over the past 10 years, and not just in the US, but in other countries as well. And you have, no wonder there is Trump, no wonder there is the Italians, the populist Italians, no wonder there is, what's her name, in France.
Good. Okay, I'm going to give you one country, Amit, because you always seem to be looking at countries, or at least stocks within countries that are not popular. And I can't think of a country other than Greece that's less popular than Italy. And I wonder, are you interested in Italy, and how do you drawn, and what's your feeling about it right now?
So, Italy has been of some interest to us. And I will say is. Specifically what happened, and I draw attention to Italy, was Italy is a nation, as Amit pointed out, of savers. There's a very large savings base. However, there are lots and lots of banks. It's wildly overbanked. However, banks in general are arguably were in many cases bust or near bust. We have the saving of the banking system in the southern part of Europe took place. Really was done for Portugal, for Spain, and for Ireland as well, and then changed the rules. So what happened was you had Italian banks which were flailing around. It was very interesting when we began to look at the Italian banks to see, is there something that's interesting here? Well, the banks, by and large, were a horrible mess. So we passed on most of them for most of the time. However, there was a bank, which is not really a bank. It was a funny sort of combination of a few entities, which it didn't do conventional bank lending, so they didn't really have the bad loans that the other banks had accumulated. It was a bank, actually, which is a long history, which I won't dwell on, but a very interesting history. The bank is called, investment bank is called Mediobanca. Now, Mediobanca has really three parts. A consumer banking business, which was clean, it was new, so there was none of these problems that afflicted the other banks existed there. They didn't do much of traditional sort of commercial lending. Two, they were the preeminent investment bank in Italy. Anything that got done, and it's a small country, it's a very, how would I put it, everybody knows everybody else's business, and that's how business often is done. And they were involved in most deals, investment banking deals. I mean, there's even the Goldmans of the world went in to do something, Mediobanca was one of the participants. But the really interesting part of Mediobanca was actually, aside from the banking business, it was originally set up to be a collection of businesses that Italians in the post-war period wanted to control. So the good salotto, the buono salotto. So what happened here was they had a portfolio of interesting assets, businesses, companies they held large positions in. One of the most interesting things they actually own and still own is the largest insurer in Italy called Generali. And so the three pieces, the three parts, the consumer banking, the investment banking, as well as this portfolio of investments, was actually quite cheap. It was actually quite cheap. This thing was close to about half of a solid book value, or sometime, let's say about a year and some ago. So again, it's continued to grow. Italy's economy has rebounded. The business at this bank has done better and better, and it's grown. But that's an example of the kind of interest that we have in Italy. Subsequently, of course, banks, they began to fix the banking system, and it's going to be a Herculean task to fix the Italian banking system because it's really quite far gone. But there are actually a few banks that have cleaned up and are clean. One of them was actually recapitalized by a person who originally was Societe Generale, fixed the bank with a huge cleanup. He basically got rid of a large chunk of the bad loans, raised an enormous amount of equity, basically cleaning, purging of all the detritus sitting on the balance sheet of the bank, so it actually starts to function. Now, the role of a bank like that, besides, of course, it was cheap when all this was going on, is in a system that's wildly overbanked, ideally, you need something to reduce the number of banks, and the government actually had begun to participate in helping with the bad loans as well as selling of the assets to the clean banks. So that's another investment that we have in Italy. But those are the two that we have in Italy.
Good. Thanks. Were there any questions that were handed in?
We have just one question so far, okay? And the question is, if you could talk about one story or trend that affects your investment strategy that has not received a lot of popular news coverage. Sure.
So, one story trend. Let me see. I mean, across the board, there's lots of these things haven't received much coverage, and are still sort of sitting there. That's what we do a lot of. We buy and we sit for long periods of time. A few things. Some time ago, we bought the McDonald's franchisee in Latin America. Yes, a sort of a lapsed vegetarian talking about McDonald's franchisee in a very carnivorous continent. The interesting thing about this was, think of McDonald's in Latin America and in developing countries is a slightly different thing than, say, the United States. it is a bit more of an aspirational good. People go there for good times, big times, and you actually see that in India as well. The big difference between the two companies, I mean, the McDonald's franchisee in India versus the one in Latin America, was that the one in Latin America it's currently around 7 times earnings, 7.5. The one in India is exactly 10 times that, about 70 times earnings, talking about excesses in either direction. And the funny thing is, if you look across the world, so I mean, those are two ends of the valuation spectrum. They have one such company in Japan as well. That's about 20-something times operating earnings. The one thing to note in addition to all of this is the one in Latin America doesn't just have operating earnings. It also owns lots of real estate. Because McDonald's historically, and the way the gentleman who runs it also bought lots of real estate. In fact, the real estate was very helpful in bailing him out in the really bad times when the Brazilian currency collapsed, the last go around. So what's puzzling, and it's obviously we sit there patiently, the consumption of burgers in Brazil has risen. It's been rising in other parts of Latin America as well. Clearly, there are difficult places to operate for them, Venezuela. People still eat hamburgers there. So really, they really do. And actually, there are YouTube videos about that, of a visit to McDonald's in Venezuela. Venezuelans have actually been posting that, comparing it with Miami, the big differences. But it's extremely unusually cheap as a valuation. So we wait. I don't think it's been recognized. I don't think so.
Mayu, is that the one that we bought?
Yeah, we had it.
Yes.
Ah,
See that? And we didn't even talk to you about it.
interesting.
Are there other?
We're going to wrap up with one last question here, and that's, can you talk about the effect of the new tax law on New York-based investments or assets?
What? New tax law. Well, I mean, the purpose of the way modus operandi historically, typically, is because most of us are personally are investors. Many of our investors are taxable individuals, taxable entities. There's two aspects to how we invest, and one is, of course, it's an extremely low turnover. Historically, we've held things for 6 years, typically is a round number. It's a 15% turnover rate. Some of it's involuntary turnover because companies get taken over. So that right there is there's a long-term aspect to our investment time horizon. So of course, that if their gains, they tend to be longer term. The second thing, typically, there's an element of tax planning in how we run the portfolios. We try to. It's not always possible. We usually have tried to have offsets in terms of taking tax losses to the extent we can, to the extent they're available. So that's, I mean, it's not really modified the way we approach it. I mean, we continue to be, as I said, tax sensitive because that's what historically was expected of us, and as investors and New York residents, we're obviously highly sensitive to something like that.
Okay, that concludes our presentation. Let's give them all a hand. We thank each of you for your own lively discussion.